Welcome to a special edition of OK Computer. I am Dan Nathan. I am joined by my friend Dan Niles. Dan, welcome back to the pod.
My pleasure as always, Dan.
All right. You are the founder of Niles Investment Management. That is a firm that you founded in early April. So for anybody who wants to hear more about Dan and his analysis, go to nilesinvestmentmanagement.com. Dan, we got a lot of stuff to talk about here. So we are recording this on Monday. This is before the Apple Worldwide Developers Conference. This is a conference that you probably have listened to or probably been at for 20 years, going back to the iPod, going to the iterations of the iPhone starting in 2007, obviously Mac refreshes, iPad launches, the whole shebang. So this one is probably the most important, you and I would probably agree, since those early days of the iPhone. So we're going to go over that. And obviously that's a bit of a preview, but a lot of stuff that's coming out of, Gurman from Bloomberg. It seems like he's got his finger on the pulse about what's going on. So we can chat a little bit about that. Also, really important to me, your macro views have been great over the last couple of years since we've been talking. So I want to kind of hit you on the macro. We know we have a Fed meeting this week. We have CPI just before that. We're not done with earnings. We have Oracle and Adobe, and we've also seen a handful of kind of enterprise software names, some of these vendors report over the last few weeks, and some big moves. So I want to get your take on that. You've also had some good takes on just AI spend and what we are expecting from a lot of these companies who've made some very big investments. And then you had a great thread on Twitter last week that I mentioned on CNBC's Fast Money about Nvidia and some of your near-term expectations and how they jive with some of your very bullish long-term expectations. So we're going to hit all of that. Let's start, Dan, with the macro and some of the things that you're expecting. First, from just kind of some of the economic data that we're getting here and what the Fed may or may not do with interest rates. And then also kind of expanding it out a little bit. There's been a bunch of elections overseas, specifically in Europe. And then we've also seen a lot of stuff on the geopolitical front as it relates to the war in Ukraine and what's going on in the Middle East. I think you have some thoughts there. So let's start, I guess, with the economic data here, inflation, and what you expect from the Fed near term.
Well, I think right now the market is looking at the world from a sort of Goldilocks scenario where any positive news that we get, like with payrolls being really strong, for example, it views it as, that means the economy is good, earnings are going to be good, so for the stock market will be good. And likewise, if the data points to any kind of slowdown, the market views that as good news too, in the sense that, that means the Fed will be able to cut. And I think to some degree that's a dangerous situation where all news is good news, good or bad. In addition to that, right now, with the Bank of Canada last week cutting for the first time since 2020, the European Central Bank cutting for the first time since 2019, and I think it may have been the first time they ever cut before the Fed cut. You've sort of got this backdrop of easy money policy continuing to keep the party going. So those are kind of the backdrop right now, which is all bullish. The negative side of that, and what's got me kind of concerned over the last couple of weeks, is I had a view coming into this year that, 2020, you had the global pandemic. Everybody had to get online. And so people signed these long-term contracts with all these different companies that helped them get online back in 2020, 3-year contracts. Well, what that means is that expired at the end of 2023. And so you're going to sign new contracts in 2024. But don't forget, we went through, to quote Mark Zuckerberg, the year of efficiency last year. So my thought was, you're going to have less employees. So you're going to need less employees to cover with these new software contracts or IT spending contracts, whatever you want to call it. You didn't really see that when companies reported their December quarters and guided for the year. But what you clearly saw this last week ago, or 2 weeks ago, I guess at this point, is that some of the biggest software vendors in the world, Salesforce, Workday, MongoDB, several others, came out and said, we've got issues for a lot of the reasons I kind of talked about, or the economy is getting a little bit worse, or in the case of Snowflake, I think they talked about, we're spending all this money on AI, it's impacting our margins. And so all of this is stuff that I go, okay, is what I was expecting at the beginning of the year starting to show up now. And what are the companies that are not off quarter that are going to report their June quarters in July? What are they going to sound like? Because if you really think about it big picture, the only two companies off the top of my head that I can think of where numbers have really gone up because of AI is Nvidia, obviously, and Supermicro. After that, the list is incredibly short to non-existent, where everybody's talking about how AI benefits them, but the rest of their business is actually dropping, offsetting any upside in AI. And so the numbers really aren't changing very much. And that's, I think in my mind, something that I am laser focused on right now, because we've got the previews coming up soon and discussions of what does Q2 look like, and more importantly, what does Q3, Q4 look like. And my belief, just very big picture, is we're going to go through a digestion phase for all of this money that has been spent on AI over the last year and a half. And to put it, simply, I fully expect a 23% correction in Nvidia between now and the end of the year because of that. And therefore, if they're going to go down that much, I think most of the other AI related names are going to get hit too. And so we're going to have to migrate through that.
Yeah, no. So it's interesting that you mentioned, obviously, Facebook, Meta in particular, the year of efficiency in 2023, and you talked a little bit about some of the guidance and some of the spend on AI. And when we got the kind of Q1 report out of Meta and that Q2 guidance, the stock, the first indication in the aftermarket was down 15% or so. And what did they do? So last year, the sequential growth in revenues Q1 to Q2 was up about 12%, right? And so they guided this last quarter, they guided down just a little bit, I think $2 billion in revenue from where the street was, but they guided spend up $2 billion from where, so it seems like they're out of that period of efficiency and they're seeing slower revenue growth. And that's a really bad model, I think, on the near term. Not that Meta is a particularly expensive stock, trading 24 times this year, 21 and a half times next, but that was really clear to me that investors were saying, you got to show us the money a little bit here, right? Especially after some of the massive gains that we've seen in the last year and a half or so in this new sort of AI phase. Does that make some sense to you?
Oh, absolutely. And don't forget, Meta stock last year tripled, almost tripled, 194%. So at this point, and now you can say that for most stocks. And if you think about last year, it didn't really matter if your numbers were going up or down. What I mean by that is Tesla's December quarter of 2023, from the beginning of 2023 to when they actually reported, went down 50%, 50. Stock doubled. Nobody cared. Same thing with Apple. Apple's December quarter that they reported, the EPS went down about 10% from the beginning of 2023 to when they reported. Stock still was up over 40%. Nobody cared. This year, people care. And you could say that's because these stocks have moved up so far in advance, they've discounted so much in advance of the improvement that now you actually got to put up the numbers. And Dell's a great example of that, where the stock had ripped off the fact that people consider them an AI play, which to some extent they are. But if you look at the forward guidance for the upcoming quarter, the numbers actually on EPS went down and the stock got absolutely hammered off of it. The most troubling thing, if you're a bull, has to be, in my mind, the Salesforce. Because if you look at Salesforce, their stock went down, I think, 21% or so the day they reported. The biggest drop prior over the last decade, the day they reported, was down 11. And that's considered a better valuation name, more stable, all of this stuff. And it went down 21% when the prior biggest drop on earnings was 11. That's got to concern you going into some of these other names, because I go, well, so what does Amazon Web Services, Google Cloud, Microsoft Azure do? Well, they hosting AI applications from all these other companies. Well, if CRM, Workday, Snowflake, MongoDB are any indication, there's some digestion going on right now. And so do you start to see some disappointing guidance for September when they report June? So that's rattling around in the back of my brain because it's not something I've heard anyone talk about, which is actually kind of interesting. And the market obviously is being held up by all this AI related names.
5 names. I mean, like, right? And so and
Absolutely.
we'll get to Nvidia in a little bit because you had a lot of great data about it. But when you think about this company started, 2020 or 2021, I think 2021 with like, a $200 billion market cap, and it just crossed $3 trillion, last week. And I want to hit one thing, Dan, and I want to go back to the macro and the Goldilocks comments that you made, because I think it's really important. I think what you're suggesting is that, the back half of this year could be a bit of an earnings recession. And when you think about that bookings growth that Salesforce just kind of announced at 3%, if you were to see that go negative, right? Like you're going to see that across the board with a lot of these enterprise software, these SaaS names, and obviously that would be very troubling. And, it's one of the things that I have been talking about it on our pods and Fast Money, because I think at some point, you see, you're stealing Peter to pay Paul as far as some of these enterprise budgets are concerned. And a lot of these folks feel like if they are not talking about what they're doing in generative AI, they're going to get penalized for that, right? And so I don't know. I just find that all pretty interesting. I definitely want to get back to Snowflake and some of these other names, Adobe and Oracle. Adobe has been one that, has acted like, grim death for about a year or so. And I want to hit what you're thinking about there. But really quickly on this Goldilocks front, because, you bring this up, and I think this is really important. Some of the things that you and I had been going back and forth with over the last week or so is you talking about being very flexible about the macro. You want to be data dependent. You sound like Fed Chair Powell a little bit here. But I think that's interesting. And that Goldilocks situation with a VIX at 13, seems a little dangerous. If people have convinced themselves that, if we get a slowdown, that's good because the Fed's going to lower interest rates. And if we don't and inflation stays, somewhat bid, well, that's also good for risk assets. And it's good. That doesn't seem to be a great place to be. And I know that you're focused on the potential for stagflation, because that's also something that probably history tells us is not great for risk asset valuations. And the last point I'm just going to make about the complacency and what you're talking about under the hood with some of the biggest names that you're focused on here is that we still have a NASDAQ and an S&P that's up 12% on the year. You know what I mean? So that's something that really seems like a dangerous setup, especially if you think that we're going to see guides lower on some important names in the September quarter or for the back half of this year.
Yeah, and don't get me wrong, there's some real big positives too. So let's touch on that. And it's never the news; it's how the market reacts to the news. And so, what are the big positives? Well, you've got the most contentious presidential election coming up. Why is that good news? Because they're going to spend an ungodly amount of money on advertising. So that's good for a name like Meta. I actually like Meta through year end because of that. It's all good for Google. Google's got some other issues we can get into, but it's also good for a name like Google. The other thing, in addition to that, is I 100% believe that sometime very shortly before the election, you're going to either get a peace treaty in the Ukraine or something in the Middle East, because for obvious reasons, every politician wants to get reelected. And so they're going to want to run on a good, hey, look what we did in either of these two regions. And those are all things that can be, very positive if you get a peace dividend, so to speak, going into the back half of the year. And that's why, as you said, I sound a little bit like Chair Fed Powell in the sense that I'm trying to be very data dependent, see how the market reacts to things. I'm very curious to see what Adobe, Avago, which has been anointed by some as the second best play behind Nvidia. We'll have to wait and see for AI. And Oracle, which has got its own set of issues with Cerner on the one hand, which maybe that wasn't a great acquisition for them, versus they've got a big one of the biggest customers is TikTok. What happens if they get kicked off? Versus I think they are gaining share as being incredible number 4 in the hyperscaler space. But almost more important than what they say is how does the market react to it? And then later today, obviously, is WWDC from Apple. Apple did what it always does, and I posted about this a couple of times. It outperformed over the last month. Well, how does it react to whatever Apple announces around AI? Where I think Apple, in a weird way, which may actually have one of the better growth profiles through the end of the year in terms of the stock, because they've been basically screwing up for 3 years. Their revenues are up a whopping 1% from 3 years ago, this March quarter versus the March quarter for 3 years ago. And to put it in perspective, if you look at the Magnificent Seven, in total, the average is up 90. Apple's up 1. So the expectations are ridiculously low. The stock's done fine because the multiples just kept expanding because people just have this ridiculous optimism over the name. They've been wrong on the fundamentals. The stock's hung in okay. It's actually one of the worst performers in terms of the stock price relative to the other Magnificent Seven. But you may actually get some kind of upgrade cycle around Apple, and nobody has any expectations around AI for them because they're so far behind that between Meta and Apple, those two may actually hang in the best between now and year end for, very different reasons. So the reaction to news, I think, is going to be really important to see. Apple normally, just for your viewers, it normally goes down the day of their product launch, and then it underperforms for the following week, which is the counter or the other side of outperforming over the month prior, which it's done beautifully. And so we'll see what happens. And, if it's stronger than that, then that tells you something important probably between now and year end.
Yeah, and let's dig in on that a little bit here because, again, I think that, it's been leaked that they signed a deal with OpenAI, and they're going to talk about that in front of developers. And again, maybe kind of, some of the excitement will be around that group because they know that there's a 2 billion global installed base, right? And so you get some good generative AI applications that are made by third parties. You get them in the App Store. It's great for Apple because it kind of rejuvenates the kind of growth within the App Store that's high margin for them. And you create an ecosystem that's likely to be very active, for 10 years, if you think about it that way. But to your point about, 1% growth in the last few years on the revenue front, that really suggests that you're seeing really stagnation among iPhone, right? That's about 55% of revenues, and there hasn't been a reason for a huge upgrade cycle. I've never been a big fan of a lot of analysts on the street talk about the super cycle upgrade, and they'll give you numbers about how many iPhone 12s are out there, and here we are on the 15. But Dan, my question for you is based on what we've seen in some of these leaks, I'm kind of hard pressed to see that when they announced the Apple 16 or the iPhone 16 in September for shipping in, let's call it mid to late October or early November, sometimes they've done staggered between the Pro and the kind of lower end. I just don't know what's going to be on the device that's going to cause an upgrade cycle. Do you know what I'm saying? So maybe better processing and the like here. What are your thoughts on that front? Because maybe this is a 2025 thing, which would extend the life cycle of existing iPhones that are out there if there's a couple 100 million or something like that that are supposedly 12s that need to be upgraded.
Well, this is what I would tell you. As you know, I've been negative on Apple's growth for a while now, and it's been right. The stock's done fine because the multiples kept expanding. Now, done fine is relative because it's underperformed the other Mag 7 names. But to some degree, that's also why this might work because, as I said, I'm very data dependent. So if you look at the latest data out of China, it looked like in the month of April, if you look at the Chinese government data, that iPhone sales were up 52% year over year in the month of April. Now, if that's anywhere near accurate, that's unbelievably strong, obviously. The other thing is Best Buy on their call talked about the fact that the new iPads that Apple introduced are selling incredibly well, which I can believe because I ordered mine about 2 weeks ago or so, and it's going to be another week to get here. So I think it was like almost a month between ordering to getting it, which shows how strong the demand actually is. And so Best Buy actually called that out on their conference call. And because consumers in general feel rich, they have jobs, their wages are going up, the stock market's up a lot this year, following being up a lot last year and the year before that, that I think to some degree, everybody's heard about AI. I use it for my job right now on the PC. If you get a thing on your phone, and the fact that the big upgrade cycle happened during COVID. And so if you say, well, that was 2020, it's 4 years hence. Yeah, you may get something. And the good news with Apple is expectations are really, really low. Now, the thing I don't like is the valuation is really, really high. It's in the high 20s and the S&P is at 22 times. But in the age of GameStop and the return to valuations really not mattering, we can argue they haven't really mattered since COVID. Um, I'm looking at the fundamentals and going, yeah, I think there's a shot based on the China data for April, based on what Best Buy had to say, based on the fact that AI seems to be important. Yeah, maybe we get a few percentage points more people upgrading than what I originally thought. And that's good enough given the stock is kind of flat for the year versus the market up double digits. And a lot of the AI names obviously up a lot more than that, that this plays a little bit of a catch up. And but I'm trying to stay flexible and keep my mind open, and we'll see how the stock reacts to whatever they announce today. And that'll also be somewhat telling, where if you don't end up with a sell-off, then it's like, okay, well, that's kind of interesting. And equally interesting to watch will be what happens at Google. Because if they announce a relationship with OpenAI, which seems to be what they're going to do, my issue with Google is I go on the positive side, they're going to benefit from the election just like Meta is. They'll benefit from the Olympics, more ad spend there. But they've got 93% share in search. Like, either you believe all of this spending on AI is going to end up with somebody gaining share, or you've got a huge problem in that sector, or you believe that 93% share that Google has in search is going to go down, which is what I'm obviously thinking is going to occur. So we'll see how Google reacts to this Worldwide Developers Conference as well. I mean, I think people know it's coming, but I've been really surprised about what I think is in the market versus what's actually in the market.
Yeah.
So
Well,
we're about to find out.
I would throw Microsoft in there too, as far as the reaction. Again, they're obviously, invested $13 billion in there. They're integrating OpenAI, technology, Copilot, they have hardware that seems exciting for the first time in a while. You probably were paying close attention to that Microsoft build. Maybe there's, kind of breathing some, like hope into Bing and search. You just talked about Google with 93% market share. But, again, if Apple is licensing OpenAI, and their technology, at some point, there's going to find some competitive balance, you know what I mean? Or competitive, situation with Microsoft. And again, you've covered Microsoft for decades. Every time they've tried to put something out on the hardware front, I think Surface is really the only thing that's caught any steam. Obviously, Xbox has been pretty popular, but again, if Apple is able to harness this technology, at least as it's from a consumer-facing standpoint, I would expect in a year or two that they're going to wipe the floor with Microsoft. I want to go back to one thing about Apple and expectations for growth. You just mentioned revenue growth. We're really kind of low single digits here, expected to notch up a little bit to mid to high single digits next year. But the thing that stands out to me, Dan, and maybe you can help explain this to me, we're expected gross margins to hit, I think, a high at 46%. At least consensus is calling for that from 44.5. What's baked into that? Because that would be the thing that could justify, a 25, 26 multiple on the out year, especially if we're going to see revenue and earnings start to ramp a little bit.
Yeah, the funny thing is I'm bullish on the revenues, but the expectations people have for margins is where I'm kind of stuck, because I look at this and I go, could Apple end up paying to have OpenAI on their phones? Because Apple's technology, I mean, people think it's a great technology company. It isn't. I mean, if you look at it, Apple spends 3% of CapEx on revenues. They spend 8% of CapEx, of R&D percentage of revenue. So you take the 3, 8, that's 11%. To put that in comparison, Meta spends 19% of their revenues in CapEx and 26% of their R&D percentage of revenue. So they're up sitting at 45. Microsoft's at 29% combined. Google's at 26. Amazon's at 23. You compare that with Apple at 11, and it tells you this is why these guys are lagging. For your viewers who aren't aware, all the other major smartphones, they already have AI integrated into it because it's coming in through the Android ecosystem, which is obviously Google's. And a lot of the best-selling phones now are the foldable categories, where it's sort of your smartphone doubles as your mini tablet. And Apple obviously doesn't have a foldable phone either. And so eventually, just scrimping on R&D, scrimping on CapEx, et cetera, it's going to start to affect your product pipeline. And maybe that's what we've seen over the last 3 years. So the margin expansion part is the part that I'm actually stuck on. But revenue, growing better than what people think, that gives you more top line to offset some pressures potentially, because they do have to do things like, okay, we're going to have to pay for OpenAI, or we're not going to get paid by OpenAI to put them on our phones, stuff like that, where Google now pays Apple to be the default search engine. So those are things that, I'm thinking about, and that's why I'm data dependent, as the Fed would put it right
Yeah,
now.
and a lot of folks have kind of highlighted the R&D there as a percent of revenues. But it's funny when you talk about this earnings growth that they have, which has been fairly anemic, and you think about how many shares they actually retire on a quarterly basis, right? They just announced a monster buyback. It's just obviously the other one was kind of done here, but I think they've returned since they started the buyback in 2012 under Tim Cook, close to like, I don't know, like they've been doing $20 billion a quarter, I think, over the last, few years or so. So they're managing earnings. This is a company that, without that, I don't think, would be growing earnings right now. So again, I think that, the lack of spend on R&D relative to revenue and the amount of buyback in dividends just seems like it's not a growth company anymore.
And yeah, and there's nothing wrong with that, right? There's plenty of stocks in the markets that aren't growth companies. At which though you go, well, why are we paying a high 20s P for it? You're valuing it like a growth company, but it isn't. And it's fine that their revenues aren't growing, and they've been able to scrimp on R&D and SG&A and all this other stuff and share buybacks to generate earnings growth. Which, by the way, if you look at GAAP EPS over the last 3 years, it's up 9% cumulatively. Average for the Magnificent Seven is 142%. Even for the S&P, it's 36%. So even with all of this financial engineering they're doing, because there's no revenue growth, they still haven't been able to get much EPS growth. Thank God the multiple keeps going up, because people have this, view that it's Apple and I got an iPhone in my pocket and I got to own it. But that's the only thing that's helped the stock. So it's one of those, it's a name that I always go back and forth on, because I go, the valuation seems ridiculous, but right now valuations don't matter, unfortunately. At some point they will, and we'll see when that is. But if you're just focused on, well, how does model change? I do think the top line probably of the Magnificent Seven has one of the best shots of maybe coming in higher than what people think, along with, a Meta.
Yeah. Well, and just to put a pin on this, conversation, or pin in this conversation, Apple on a few occasions over the last, call it, year or so, has gotten up to this kind of 195 level, and with an inability to kind of break out. So this is the third time. It just had about a 20% rally off of its April lows or so. And down at the April lows, when the stock is in the mid 160s, you've taken a few turns off that multiple, and it seems sort of reasonable, right? So I guess the thing that I have a hard time thinking about is, what are they going to announce today? This is Monday again, that causes investors, right, to get better confidence about, reaccelerating earnings and revenue growth, and establish a new range above this $200 level. So I'm hard pressed. And you've been talking about this, I know, for the last month or so, again, that the stock rallies usually into WWDC, sells off that day, and then you have a little bit of a digestion, especially as you go into this seasonally weak period for iPhones before you have the fall launch of them. So again, I'm kind of in your camp a little bit. I want to hit these some of these software names really quickly, because you kind of alluded to them. And one of the ones that I think is really interesting to me, and we'll talk about Adobe in a second, is Snowflake. This is one that a lot of folks, are very bullish about not too long ago, right? About AI and the spend there. And the stock is now off about 45% in just a couple months from a new 52-week high. This is a $46 billion market cap that trades at about 10, 11 times sales or so, that just basically got cut in half, Dan. So we talk about, valuations not mattering. They do matter in certain pockets of the tech market here. So why do you think this is something where, in some of these software names, again, Adobe is down about 30% over the last few months. It's down more than that from its all-time highs made a couple years ago, and it never really got back to those levels. Why are tech investors being so discerning here about the names that have the goods right now? Even a Google, which has had this huge move, I think about 30% in the last few months, It looks like a crowded trade. Microsoft feels a bit crowded here, but some of these other software names, shoot first, ask questions later.
Well, I think with software, you have to remember for, I don't even know how many years right now, there's been sort of this mantra amongst investors, which is software eats the world. And I forget which, it might have been Andreessen.
Yeah,
I forget
it was
who's-
Andreessen about 10 years ago, I think he wrote
yeah.
that blog
And
post.
so that's been kind of the view of the value isn't in the hardware, it's in the software. And that's been sort of the go-to mantra. What has changed is over the last year, and especially with the results recently from Salesforce, Workday, Snowflake, MongoDB, you run through their names. Well, is AI actually bad for software because you have less people and therefore you need less software licenses, you need less subscriptions. And so AI is actually really bad for these names. And that's what's changed. And that's a big mind switch change where, well, semiconductors, like, yeah, that's just the stuff you build the software on. Like nobody goes and buys a semiconductor chip. They buy a piece of software that runs on hardware, right? So that's the big psychological shift that investors are going through. And that's why you're seeing the software needs all of a sudden getting just absolutely hammered, because now you're going from they're going to take over the world to maybe they actually are going to get screwed by this switch to AI.
Yeah. Yeah, no doubt. All right, let's talk about Nvidia and this tweet thread, I guess, that you put out last week. And again, it started out by saying your belief is that over the next 3 to 4 years, you expect Nvidia's revenues to triple. But you're basically also have plenty of cautionary comments about, your view of history when a lot of investors became universally bullish on some of these names and how they were going to play in this new sort of, era of computing. And this goes back, 24 years, 25 years. You were covering, I think on the sell side at the time, a lot of those names at the forefront. And I think about just the idea over the next 3 or 4 years that Nvidia's revenues might triple. That would basically get you to where Apple's revenues are, in and around $400 billion, annually. And again, this is a company that put up, 76% gross margins. Again, for a semiconductor company, we've never seen that before, and definitely not on this scale. So talk to us a little bit about this nuance, okay, between what your 3-4 year view is about what they're going to do on the revenue front. But you just mentioned that you could see this stock down 35% even by year end. And again, from its highs in, I think, March to its lows in April, the stock sold off 21%. So the idea of being down 35-40 makes sense to me, especially if you, and I think you've highlighted this in some of your work of late and some of your commentary, that you think AI spend is probably getting to a point where it's about as good as it gets in the near term. And obviously, Nvidia will be at the forefront of any reduced spending in and around AI. And we know how expensive these high-end GPUs, and you've also mentioned, I think the last time you were on the pod, is that when you get these sort of product transitions that they are likely to undergo, right, from this H100 series to Blackwell, and then they just articulated 2026, which is Rubin, they're giving you plenty to think about, but you also have to think about what are some of the gaps that you have in spending in the middle of these sort of product transitions.
Yeah, so I think if you go back to the internet, that's probably pretty instructive. And so if you take Cisco, which became the most valuable company in the world in 2000, and what happened there, if you use Netscape Navigator's launch, which was the first, you could argue, mass internet web browser at the end of 1994, if you say, all right, so Cisco's revenues at the end of 1994 were around 400 million. And they went up 15 and a half times with no down sequential revenue quarters from the end of 94 till about early 2000. No sequential down revenue quarters. And the revenues again were up 15 and a half times. The stock went up 4,000%. So that's the backdrop. Now, get into the micro of, well, how did you get there? You went through arguably 3 distinct phases of inventory or of spending digestion over that 5-year ramp in the stock. And the Cisco stock went down 26% in late 1995. It went down 38% or so in early 1997. And then it went down 37% in late 1998 from peak to trough. Every one of those years, the stock was up, but you had some massive drawdowns in between as you went through spending digestion. And so all I'm saying with Nvidia is, so contrast this, Nvidia's revenues have gone from about 5.9 billion the quarter before we heard about this thing called ChatGPT, et cetera, to 26 billion. So the revenues are up 4.5 times. They're not up 15.5 times like Cisco was, but this is over a year and a half. Now you're starting to hear about things like from CRM, Workday, MongoDB, Snowflake around growth slowing. And so it's not that far to imagine between that capacity having ramped. So now TSMC can provide a lot more of the chips. And you're starting to hear about guys having what they need. I thought Elon Musk's commentary of, hey, if we took shipment of those things, they'd be just sitting in a warehouse was really instructive. It says guys have ordered, which we all know, right? If a year ago you ordered a chip, you got an Nvidia chip a year from when you ordered it. Now that's down to about 3 months. Blackwell, which is the latest generation, has already started to ship. And so at some point in the next 6 months, I think what you're going to see is, much like you saw with Cisco, the sequential revenue growth slowing down pretty dramatically from what it's been running. And therefore, investors going, well, at the end customer level, they're trying to figure out, well, where am I getting the return on the money that I'm spending? And so you see the growth slow and the stock get hit, much like you saw with Cisco 3 different times, as it continued to ramp its revenues every quarter, but the stock got very volatile. So that's what I'm saying with Nvidia right now, which people, it's the classic case of they love a stock, and the momentum and the chart, it all looks good. I'm looking at the fundamentals of the business underneath it and just saying, hey, you know what the customers are doing, because you already heard from 4 big guys that are in the AI space, or say they are. Well, is it going to surprise you that much if companies come back and say there's not just one Tesla out there that says the chips will be sitting in the warehouse, but there's a few more, because the returns in some of these segments aren't quite what people thought they were going to be. And so they're going to have to digest some of that spend. Don't forget, right before this whole thing started, NVIDIA's revenues almost went down 30% in 6 months.
Yeah.
In 2022 at the beginning of it, because the data centers, which is Microsoft, Amazon, Google, were digesting a whole bunch of inventory. And people tend to forget. So that's not that long ago.
Dan, I don't forget that. I bring it up on Fast Money all the time, that some of your, and I don't mean you, some of the investing public's most favorite names at the end of 2021, Netflix, Meta, Tesla, and Nvidia, they sold off 75%. And the excitement about metaverse and data center and the combination of it's not too different about generative AI, except for the TAM, right? And except for how we are convinced it's going to disrupt computing the way we know it over the 10 years and the next 10 years. But to your point, there's going to be, some volatility in around that. And I've been making this point also, is that if that expected 32% revenue and earnings growth for NVIDIA next year, okay, let's call it calendar 2026, okay, decelerates more than, let's say, from where we are at 100% this year, 80, 90%, whatever the hell it is, right? It doesn't really matter, because the stock is up, 145%. It encapsulates all the growth that we've seen this year on a multiple basis. But if this thing were to go back to the April lows, okay, the April lows, you're talking about a 40% drawdown. That could easily happen. And then if you have a slowing economy, and to your point about licenses, okay, so you have 2 things. At some point, a lot of these tech companies, a lot of companies across the board are likely to cut jobs. We are at 50-year unemployment, right? At 3.9% or so. If you have unemployment go up to 4.5%, which was kind of the goal of the Fed in this rate hiking cycle, to slow down the economy a little bit, then you're going to have less licenses, right? And you're going to have less investment, I think, in the near term. And so to me, I think a 40% drawdown could be easy. And this chart is unchecked. It consolidated, from that kind of March to April period. It did have that 20% drawdown, but on that guidance that they gave, the stock gapped up 10% and just kept on going. So to me, that needs to be checked a little bit. I want to make one other point that you just made about Tesla and kind of moving over the deliveries of some of these H100s over to XAI and to Twitter. Tesla's screwed, in my opinion, okay? And I've said this for a long time. If they can't use those chips for full self-driving, supervised full self-driving, which is what they have to call it, because we know that this is not a LiDAR-based thing, right? This is supposedly this amazing, AI interface, and they needed all those chips supposedly to get to robotaxi and everything, and that's the story going forward, right? They just got rid of this low-end vision for an EV. Then to me, if they can't use those chips, then full self-driving, again, is never going to land the way that Elon thinks it's going to. And I think this stock has plenty more downside, in my opinion, especially when you see some of the delivery estimates for the balance of this year and in China. And I think BYD is eating their lunch in China. You saw that hybrid EV with 1,300 mile range. The cost is $15,000. That's insane. So to me, I'm just thoughts on that really quickly, because I know that you obviously long-term are very bullish about Tesla. You've been very cautious over the last year every time I've talked to you.
Yeah, I would disagree with one thing you said. I think they will get to full self-driving. Elon is the most brilliant guy in tech that exists, arguably with Jensen of Nvidia. And so I disagree. I think they'll get there. Now, having said that, everything else you said, I agree with, which is there's a ton of competition from China. The US government doesn't like Tesla because they're not unionized. That's a problem. When you're fighting a government, which happens to be your own. And you've got, because interest rates are much higher, it's harder to finance purchase of a vehicle, where a lot of people take out financing, right? They don't buy it all at once. And then you combine that with a PE multiple, which is, 80 times or so. And they're in a tough spot. And if Tesla doesn't approve Elon's pay package, which I think it's ridiculous that you sign a package and then you rescind it, a contract, then a lot of the AI developments are likely to happen outside of Tesla. So I think that there's a lot of reasons that Tesla is in a tough spot. I do look at valuations. I know we talked about Apple and et cetera, but I think the numbers look high for a Tesla, and EV demand around the world is slowing down. And so those are my issues.
Well, really quickly, I don't.
And one thing I do want to be clear with Nvidia, just I want this to get lost, is that if you compare where Nvidia's revenues are now, they're up 4.5 times from the end of 2022. Cisco's revenue went up 15.5 times. So that's why my belief is that Nvidia is in a much stronger position than Cisco was, where Cisco have, Lucent and Alcatel and Nortel and a whole bunch of competitors. Nvidia really doesn't have anybody, but the revenues are up 4.5 times in a year and a half. For Cisco, their revenues were up 2.5 times in a year and a half during the beginning of the internet build. So it shows you just how fast the ramp is too. And so just saying that there's digestion doesn't mean this is the end of it. I think Nvidia is going to have a down sequential quarter for years, but I do think it's going to slow down quite a bit from where it's been.
Yeah.
So I just,
No, I listen, that I agree in. And I don't disagree that Elon will ultimately get to full self-driving. Okay. Like that will happen. It just will never happen on the timetable that he says publicly, because you can go back and look at every comment he's made over the last 10 years, and he's never hit any of those sorts of, you know what I mean? So that's my only point. And that will continue to weigh on the stock with a valuation where it is, especially when you have, again, going back to that competition. But if I'm looking at on a gap basis, okay, Tesla this year is expected to see EPS down 50%, and then it's expected to grow 43% next year. And I just don't see that happening. And I think you just alluded to that. And then on a revenue basis, we've seen revenues are just this year expected to be up low single digits. if their deliveries come in worse than expected right now, and I think the street is way high on deliveries here because they've gone X growth here on that the first time ever, then you have negative, okay, revenue growth this year with an expectation that they're going to gain 18 or so percent. So it's I'm not certain of that. I mean, like, not at all. So to me, again, I don't think Tesla's a great short here. But by the same token, I don't think it's a particularly good long. I think there needs to be a reckoning of this name a little bit. So that's just my 2 cents. And I've kind of been steadfast on that for a couple years. Timing that is really hard. But if you look at the series of lower highs from $400 with a stock at $175 here and lower lows, I say to you that move that we saw from 200 to 100, right, at the end of 2022, that's why the stock went up 100%. You know what I mean? Because it dropped 50% in about 2 months or so. And so to me, I just think it's been, upper left, bottom right. And I think we probably go back, maybe to $100 over the next year or so, especially if they can't reaccelerate growth. And the last point is the margins, auto gross margins are right where Ford and GM are. And I don't know if you see GM, but they've pivoted obviously, and they're, going heavy into hybrid EVs. Elon on the last call said they're all wrong, that hybrid's not going to be the way of the future. And look at GM making new 52-week highs today as we speak. And we don't have to get bogged down in Tesla, and we only have a few more minutes here, but that's my 2 cents. And as brilliant as Elon is, if he doesn't get this pay package, this moving of XAI, the chips to XAI, highlight the fact that he may be out at Tesla. And you tell me, if he's out at Tesla because he sees better opportunities at XAI and SpaceX, and maybe even Twitter, which is basically a zero right now for all intents and purposes, then he goes there, then Tesla easily goes back to $100.
Out of the Mag 7, this is the name I'm most negative on from a longer term basis, because the valuation against revenues, which are down 9% year over year in March, which is the first down year over year quarter they've had since COVID, the peak of COVID, it's just hard for me to reconcile that versus the competition issues that are going on, plus the issues that Elon's having at Tesla relative to his PayPal, etc. So we'll see what happens. Tesla's a tough one for me because I absolutely think Elon's a god when it comes to technology, and industries he's changed. But there's a difference between that and a tough EV market, which he's in, fighting the government, which is hard, and evaluation, which is still extreme.
Yeah. And again, I just want to make one last point. If he's a god to you, he also has made some huge bonehead miscalculations. The whole idea of starting this price war and that there would be price elasticity, I think he's underestimated the Chinese EV makers. He's flipped back and forth between tariffs. On January 26th, on that Q4 report, he said that if we don't put some sort of trade barriers up, that the Chinese EVs are going to own the world, right? And I think he's right about that. But then for some reason, just a few weeks ago, he flip-flopped on that and doesn't think there should be tariffs. And I wonder if that has something to do, again, with, obviously competition within China, okay? And then a whole host of other things. But if he's as brilliant, and then the other bonehead move was Twitter. And obviously he wanted to get out of that. He realized that fairly quickly, but he lit on fire $30 billion, you know what I mean, from his own money and investors' money. And so to me, I think for as genius as he's been just last week with the Starship and Starlink and everything that's going on in SpaceX, you know what I mean, and what he's likely to do with XAI, but I don't know about you, man, Grok is a loser. It's a total zero. It's actually one of the worst products I've seen on the market. So they have a lot of wood to chop there. And then, so that's just my 2 cents.
Look, you can be God in technology and have issues with your businesses from time to time. It's why Mark Zuckerberg, Facebook had this thing of move fast, break things. It's the fastest movers, they're going to be the ones that invent stuff. And so and by definition, I have no problems with him dreaming big, because if he didn't, there's no way, there's nobody in their right mind that starts an auto company and thinks that it's an incredibly capex intensive industry. Yet this guy did it, changed the world as we know it. And so, yeah, we can get into some of the latest moves that he's done. which have been problematic. But I mean, I kind of go back to what Warren Buffett said, which is, when a great business manager or whatever meets a bad business, the business will keep its reputation intact. And unfortunately, the EV business has turned from a fast growing business to something that's going through, a maturing life cycle. And that's going to color people's view of this. And so,
yeah, but again, Dan, he just overbuilt capacity all over the place with these gigafactories and not seeing
Amazon Web Services, Microsoft, Google, all these companies, every tech company on the planet, always in an upcycle, overbuilds capacity to work it back. So, Tesla's in no different situation than any of them. And they just have multiple massive headwinds working against them, where Chinese are supporting their car companies. We're not supporting Tesla. That in and of itself is a huge problem. And supporting Ford and GM against Tesla, that's a major issue.
Yeah, and again, higher for longer. You just mentioned financing costs. Higher for longer is a disaster for. And I get emails once a week from Tesla. They're trying to buy down rates there, and that's the thing that will obviously continue to weigh on margins. I just want to make one other point about XAI. Elon obviously was one of the initial investors in OpenAI, and I believe he used to get in lots of little public spats with people about the future of AI and AGI and a benevolent, AI. And that was one of the main reasons that they created this nonprofit. I think he put $100 million in. And when I think about what he's trying to do with XAI and position against OpenAI, and what I've seen with Twitter since he took it over, I'm not particularly optimistic that he still has that same view about a benevolent AI, because every time I log on to Twitter, and I don't use it particularly a lot, I just use it to retweet, when I see what's trending, it's always Elon, and it's always Tesla, and it's always SpaceX, and you know what I mean, and Starlink. He is putting his finger on the scales at Twitter, no doubt about it. You know what I mean? So I'm not particularly interested, because he's got, he thinks this woke mind virus is going to ruin the world or this or whatever. I wouldn't trust his AI. That's just my 2 cents. You know what I mean? And when you think about the most powerful man in the world and what he controls amongst his portfolio of companies, and then obviously his wealth, and then being red pilled the way he has of late, that's not something that's particularly interesting to me, and I think could be quite dangerous, but that's my 2 cents. You don't have to respond to that. You and I have already had that disagreement there. So, hey, listen, Dan, I really appreciate it. I know we're running up against time, but if you have any kind of final thoughts here, I love this conversation. I really appreciate you doing it, and you and I can go back and forth, and we can disagree here and there, but it's always going to be really cordial. And I think of you as a tech investor and a tech analyst sometimes the way you feel about Elon, because you've been doing it consistently for 30 years. And I'm just in awe of your track record, also.
Well, I appreciate it. Thanks. It's always nice having a conversation, and it's good to get into discussions on both sides, because that's what I try to do.
Yeah.
I want to see both sides of an argument and then make your decision. And sometimes you're right, sometimes you're wrong. But I think the key for everybody listening to this podcast is be flexible in your thinking. And if the facts change, you need to change. And so I think that's going to be super important between now and the end of the year. And June quarter are going to be really important. So keep your minds open to whatever you hear.
I agree with that. Hopefully you can come back as we get into mid-July, and we're going to kind of hear from a lot of these companies about, Q2 earnings and Q3 guidance, because I agree with you. I think it's important also for investors to remember that was the same time period that we, had a 10% or a start of a 10, 11% drawdown in the S&P last year. And I think for a lot of the same reasons that we've just spent nearly an hour talking about. So maybe you see July, August as a little rocky, especially if some of these companies that we're already a little worried about and have been performing really poorly, have guidance that is just not up to snuff. So I appreciate that. All right, listen, if you guys want to find more about Dan and his new firm, it's nilesinvestmentmanagement.com. Go check it out. Dan, I hope to see you on Fast Money really soon, and I look to do this again, hopefully in the not so distant future before Q2 earnings.
I appreciate the time, Dan.